That's only the FVA story. Published a paper on this on risk in February, and there is one that is just about to come out because I collected the proofs. But there's other stories along this line. Regarding initial margin, in the context where I'm working, right, based on operator algebra as opposed to being based on standard mathematical finance, actually calculating full valuation, full reval VAR in the future for each netting set does not require a nested simulation. It can be done with purely algebraic means. Meaning, I can project out a future VAR. And out of a future VAR, then I can project out initial margin, I can project out, which is also very important, I can project out haircuts if the bank uses internal models. And then on that basis, one can come up with the cost of funding, initial margin obligation. So the cost of simulating initial margin is nil. Absolutely nil. Can be done with pure algebraic means, if you're working in this formalism. Independently of any model, just on that basis, one can then compute the MVA, and the MVA is used for several purposes. One is transfer pricing, another is a capital deduction. But finally, there is also going to be an MVA VAR. I mean, let's face it, I mean, MVA should be part of economic capital, should already be part of Pillar 2 economic capital, because it's variable, and because the variability of initial margin costs is very large, and it's very vicious in a way, and very dangerous. Because just think at a situation where a bank starts getting into a crisis. That situation, they will have to mark to market the FVA and the MVA on their own spread. If the spread goes up, just by the sake of this move in the spread of the bank will have to register a greater capital deduction. So it's very important to model FVA VAR and MVA VAR, I mean the variability, projected out over the lifetime of the trades. And see what impact that has, especially on a stress testing basis. Of course, the impact of initial margin on economic capital then translates into greater capital costs. If you think in terms of economic capital, at least, and you are not waiting for regulator to slam a regulatory charge on this, and as a KVA incremental impact. In general, I really like the notion of Pillar 2 economic capital, because the more I talk to regulators, the more they express their concern that all of their Pillar 1 charges nowadays are actually overlapping with each other. There's many. They are simplified. They are given by simple formulas because people want simple formulas to value. And they all overlap with each other. The approach I'm taking here is to say, well, let's do a brute force calculation. There is a lot of merit in brute force. If you do a brute force holistic calculation, you run your billion scenarios in with market and credit simulation and all that, you don't need these simplifications. You can really do the exact calculation. So all of these overlapping charges then can all be synthesized into something economically more meaningful, which is that expected shortfall on returns on Tier 1 capital. The moment you can simulate Tier 1 capital, all you need is expected shortfall on Tier 1 capital returns over a yearly holding period. That's all you need. Now, this is possible. That's something that perhaps not all regulators know, but this is technically possible on hardware that costs a tenth of what people are using. You just have to change mathematics and change information technology setups. But it is possible. So I believe in it. And I believe that the world will go that way because regulators are very worried about the overlap problem. And from a transfer pricing viewpoint, since most of my clients are actually front desk traders, what I recommend is that the KVA be computed with economic capital, not with regulatory capital. Maybe you can use regulatory capital up front for a couple of years, but otherwise It's wise to use economic capital because if you have a 30-year swap, I can't believe that the world will go on for 30 years with 12 overlapping charges given by approximate formulas. I mean, I just can't believe. There is a lot of effort that we can already see towards converging Pillar 1 with Pillar 2. So, KVA, I mean, the KVA, as you recall, was defined by this formula here a few slides back. By this third formula here, as exponentially weighted average of the hurdle rate. As Moes was saying, the KVA has a very important meaning in accounting terms. People have realized, when the crisis struck, that the derivative business was a big Ponzi scheme in terms of capital. Why? Well, because of the Black-Scholes model, in a way. Let's blame it on Black-Scholes. So how were things organized? Well, accounting for OTC derivatives was very simple. It was all done on the basis of the hypothesis of market completeness. So you could replicate everything. You would assume that you can replicate each and every transaction. So you make a transaction and you value it, discounted expectations, and you get one price. But then you go to the client and say, well, okay, I mean, actually, I have to charge a bit more because I need to pay dividends to my shareholders. I need to have a bit of a profit here. Shareholders are providing capital, providing risk capitals. Regulators want me to have risk capital. So I need to pay the dividend. So I'm going to charge my client a bit more. That bit more is the profit. But once received on a fair valuation basis, that profit was immediately identified as a distributable dividend. So bang, it was given to shareholders. Now suppose that this is done on year one, a bank comes into existence, does its first 30-year swap, and that there's one swap on the book and does that. Year two, the bank gave away already the dividend. Now they still have a 29-year-old swap. What can they do? I mean, they still need capital. How are they going to pay dividend flow? Let's have two more swaps, okay, and have a bit more of a profit that we give away to compensate shareholders for the capital for the two new swaps, but also for the older one. Fast forward 30 years, you see banks shoving down the throat of municipalities exotic derivatives. Because this scheme can sustain only if there is exponential growth in volumes. What was missing out of the picture was an organized way to pass on capital cost to clients, retain those profits as earnings, and then distribute those earnings across the lifetime of the trade to shareholders in an incremental way, in such a way that the whole scheme would end up being sustainable, meaning that shareholders would always receive an expecting dividend proportional to the capital posted by a given hurdle rate. Let's say 10% hurdle rate, if that's what they want, okay. Let's have it sustainable. Let's work on a runoff basis. We assume we have the trades we have today. Assume there are no further trades coming into the portfolio anytime in the future. And let's see how we can distribute our earnings to dividends throughout the lifetime of the book in proportion to the capital at risk. And this is the problem which is solved by the KVA. It's an absolutely central problem that contributed to the blow up in the crisis, and hopefully by fixing it will in a way make banking more stable and more sustainable. So the KVA is extremely important. The accounting framework for KVA, unfortunately, is still in a state of flux on the OTC side, but fortunately, I mean on the good news side of the story, an accounting framework in the insurance industry is already in place, starting from this year, after 10 years of debate. It's called IFRS 4 Phase 2. If you're interested in the concept and in accounting as much as I am, I would encourage you to Google this, IFRS 4 Phase 2. And if you Google that, you'll see that in the insurance industry they've already been putting in place this kind of mark-to-market method to distribute dividends, which in a way allows for this kind of sustainable scheme. The definition of the KVA that I gave, like exponentially weighted average with a hurdle rate, is there to ensure that as you do this mark-to-market exercise on the KVA, the expectation of this KVA, a derivative with respect to time, is precisely equal to, well, RKVA means this is the martingale portion, but then there is a minus, which indicates this is a sub-martingale, actually, because it's actually coming down. And the minus here includes an H, which is the hurdle rate, times this difference. I mean, this is the difference between economic capital and KVA. Now, why do we have this difference? Well, because you have to imagine that economic capital is made up of two portions. One is shareholder capital, and shareholders need to be compensated with the dividend stream proportional to hurdle rate. But the other part comes from clients. The part of capital coming from clients is the KVA, right? So what we need is to be able to pay dividends to shareholders, right? So what matters here is the difference between economic capital and KVA. And if you work out the math, you see that exponentially discounted equation precisely give rise to this kind of compensation to shareholders, which is what we require. The KVA in this book is 350. Now the KVA computed here includes the CCR charge, I mean the default risk. I mean, we look at the whole loss distribution due to defaults. This also includes the variability of the CVA on a full reval basis, meaning, you know, we just project out scenarios and look at how the CVA can change as a function of time in correlation with the default process. We also look at how the FVA changes as a function of time and how the MVA changes as a function of time. We look at the three components, meaning we simulate core equity tier 1 capital. And we arrived to this KVA using Pillar 2 economic capital, which is a 350. It's about 30% above the CVA. This number is a bit low with respect to numbers that you find in the literature by Green and Canyon and others, which is typically 50 to 100% above the CVA. We have a bit of a lower number because we are using a Pillar 2 economic capital model. And Pillar 2 economic capital, I mean, Pillar 1 charges are conservative with respect to Pillar 2. That's why. So to have a more realistic number, what one could do is for a couple of years to use regulatory capital and then switch to economic capital, hoping that regulators will catch up. That's another possibility. That will increase a bit KVA, but perhaps not all the way to 100%, because I have a hard time believing that regulators for the next 30 years are going to keep on insisting on simplified formulas. At some point, they will also start believing in brute force, hopefully. There was an article on Rich Magazine that appeared about 3 weeks ago that prompted me to call up the journalist right away and tell her about what the hell are you writing. The title was like KVA losses on the horizon can be larger than FVA losses. My point here is that I don't really see the introduction of KVA as causing any losses whatsoever. In my opinion, KVA is a huge misnomer. Firstly, because K was supposed to be an indicator of regulatory capital, Pillar 1, which is not right. And then secondly, because VA means valuation adjustment. This is not a valuation adjustment. I'm calling it KVA only because everybody calls it KVA. But it is a huge misnomer. This is not a valuation adjustment in accounting terms. This is a risk adjustment. The KVA is an intertemporal risk measure. I'm very happy to have Mark back here. You wrote some fundamental papers on this one. So you know about coherent risk measures. If you look at IFRS 4 Phase 2 at the accounting documents, what they say is that they introduced this new notion of risk adjustment different from valuation adjustment. And they say a risk adjustment must be a coherent risk measure, an intertemporal coherent risk measure, which is an amount which is transferred to clients and received, and then retained as retained earnings and distributed as time goes on. That's what it is. It's a coherent risk measure. Read the head paper 15 years ago, or read IFRS 4 phase 2. So the right way to compute it is as function of expected shortfall, and that's what we are doing here. So when KVA accounting will come in place, I think what will happen is that banks will look at their retained earnings, and they will say, well, based on the level of retained earnings we have, our implied hurdle rate nowadays is a modest 4%. However, our target hurdle rate is 10%. And that's what management is going to do to get our target hurdle rate for our shareholders up to 10%. That's the kind of communication that will take place. They're not going to say, now all of a sudden we have to recognize capital costs and our fair valuation will come down by $500 million. And also, they are not going to have to deduct the KVA from Tier 1 capital. I mean, this is something that is very circuitous and a real misnomer. The whole notion that you take KVA and deduct it from Tier 1 capital, I believe, is just really faulty. Again, the KVA is not a valuation adjustment, is not a Tier 1 deduction, it's a risk adjustment. Read IFRS 4 phase 2 to figure out how debt interacts with Solvency II in the insurance industry context. I think that applies perfectly also to banking. The KVA is not just an extremely useful accounting metrics that will resolve the Ponzi scheme of derivative markets. It is also a metric that has a lot of other implications. Because the moment you understand how capital policies feed into the dividend stream, and you have one metric for that, that number can be used for just about all other management decisions. All other management decisions that nowadays can be based on many different numbers cannot be unified in terms of KVA. In particular, KVA can be used as a substitute for PFEs. Now, PFEs are numbers that are used to project out the potential future exposure on a client-by-client basis. So to compute them, you take the portfolio of one client, and then you go look at the potential future exposure for that client. And that, in a way, sets the credit limit for that client. Problems with the PFEs is that they are independent of the way market risk and credit risk are correlated with each other. And they are independent of the endowment, what academics call the endowment, the portfolio of holdings. I mean, see, and this is something that people are coming to realize is really absurd. As I said, we are moving from finance based on the notion of a transaction by transaction kind of business model, where if you have a fancy exotic derivative, you can make a lot of profit for your shareholders, and on day one, as soon as you transact, and then you can keep on going until when it all blows up. We are moving from that business model to a business model where in banking people are coming to realize that actually you need to do portfolio optimization. This is a huge realization. It never happened before. Bankers realizing that you need to do portfolio optimization in derivatives. Wow, groundbreaking. What does that mean? That means whenever you do a swap, you need to see what the capital impact is of the swap is, because that swap interacts with all the other swaps you have, and it may well be that that swap you have with one client actually is a partial hedge to a swap you have with another client, which is good news. May also be that the swap you have with one client actually causes hurt. It's important to distinguish these two situations. And in this graph, I'm showing precisely a comparison between KVA and PFE. So what I'm doing here is to look at a scatter plot. I mean, on the x-axis, I have my PFEs for the net insets in my portfolio. On the y-axis, I have the incremental KVAs, meaning I take the net inset for one counterparty, I take it out from my portfolio, and I look at how my KVA changes. That's the incremental KVA or decremental KVA for the counterparty, and then I plot them all. What you see here is that there are situations where the PFE is very large, but the incremental KVA is very small, as well as there are situations where the PFE is large and also the incremental KVA is large. These two types of situation indicate that you can have a large PFE, meaning a large exposure to one client, but you can actually have two situations. Although you have a large exposure, with client A, which is up here, the exposure is actually hurting, consuming capital, taking you away from the optimal, increasing your intertemporal coherent risk measure. The exposure instead that you have with this client here is reducing your risk measure. It has a negative KVA decremental because this exposure may be large, but it's a natural hedge. To what? Well, it's not clear. I mean, you've got to drill down to find out. It may be a natural hedge for funding, maybe a natural hedge on the CVA side, maybe a natural hedge on the market side. I mean, the KVA contains all of these elements in interaction, so you need to drill down to see why. But you have these big discrepancies. Being able to detect these big discrepancies is becoming key in managing derivative books. This amounts to basically identifying cross-selling opportunities. A bank has many different desks. Can have several swap desks, they may have several FX desks. These desks sometimes refer to the same client. One trade by one desk can be a natural hedge to the trade made by another desk. If this situation is detected, meaning if one detects that a new trade has negative KVA, people should know, sales should know. They should know that they should close the deal, that they could close the deal at zero cost of capital and still have an advantageous trade. They should know. That's a cross-selling opportunity. Even if capital is allocated on a desk-by-desk basis, that means you can have then a trade between the two desks to decrease capital on both sides. I know that there are banks that have very aggressive bonus policies to encourage cross-selling. What is missing is analytical tools to identify those opportunities, because how can you do? You call up on the phone and the other traders. I mean, you really need a system-wide, a bank-wide infrastructure that identifies these cross-selling opportunities and tells traders that, well, that's a good trade, do it. You can give a discount. And other cross-sellings are possible between bank and bank, if they manage to communicate. Another application of KVA is to stress testing and cigar exercises. I mean, to do stress testing, what you need to do is to figure out what are the scenarios that hurt you the most. Now, I told you about computing decrementos of the KVA with respect to counterparties. You need to wrap it up. Just one more slide. Decrementos of KVA with respect to counterparties, but you can also compute decrementos with respect to scenarios. Meaning you can, let's say you have 20,000 primary scenarios plus a lot of secondary scenarios. You can take off one scenario. If you take off one scenario out of your simulation, you can ask how much is my KVA coming down, and scenarios that once you take them off, reduce your KVA by a lot are those that are most promising as the stress scenarios. By doing this kind of analysis, one arrives to an automatic way of singling out scenarios that are bad, in a way, that represent stress conditions in the future, but in a way, in a holistic way, by looking at the interaction of the entire portfolio, by looking at all the XVAs in interaction with each other. This is a kind of graph that we created by looking at this reverse stress testing analysis and then asking, you know, what's going to be my level of interest rates in case I have a stress condition. And the answer here was that, well, my interest rates are largely going to be low, which is natural. But there are also some stress situations where interest rates are not low, meaning there are stress conditions that are unrelated to rates. These outliers are fewer, but they are, as a matter of fact, the most interesting ones, because these are the ones that identify specific portfolio vulnerabilities, which are independent of the credit and interest rate cycle. And this is another three-dimensional graph looking across gammas, meaning looking at how these outliers can also be, you know, projected out in 3D graphs, joining two different risk factors to distinguish between systematic, cycle-driven crisis points with idiosyncratic ones. This kind of in-memory technology, I believe, has two kinds of applications. I mean, one pre-trade and one post-trade. I mean, on a pre-trade basis, I mean, cross-selling, decremental KVAs are really important. And to put it in place, I think one has to take these boxes working in isolation from current systems because they have to be fast. The other type of application is on a post-trade basis, where it becomes relevant for banks to reuse their validated models, in which case one can have a more like a federated type of approach and using memory analytics as an accelerator of existing systems. So you use existing systems for pricing, and then use these in-memory boxes as an accelerator. With the cost of valuing 1,000 scenarios out of an existing system, you can then seed the in-memory box, and that can give you 1 billion scenarios, nested simulations, credit market simulations, and all that. So these are the two ways this can work. Since I'm running out of time, I'm just going to hop to my list of references and ask you if there are any questions. I mean, the summary and the conclusions here is that it's worthwhile looking at brute force solutions, and I showed you what you can do with it.
Thank you. Thank you. Okay, questions? We solved a lot of problems this morning. I hope you'll be able to implement that. Question?